Okay, let me ask you these things first. How many of you are aware of basic support and resistances? Hello, everyone. Do you have the concept of, forget support resistance, do you have the concept of demand and supply? Do you understand what demand is, what supply is? Okay, okay. So let me start there. Let me start with demand supply, and then we will progress slowly. Think about this. We in USA, avocados come from Mexico, right? Now, if you had noticed around 2015, there was some problem with the supply of avocados coming into USA, okay, from Mexico. Now, the say for example, the whole population of United States consumes say 100 100 million pounds of avocados every year, correct? And that demand has not changed. What changed? There became a bottleneck at the supply, at the source. And what happened due to that? There was a scarcity of that particular product in a market which had a pretty good demand for that, right? As a result of which, because the demand became so low, as a result of that, the prices of the demand stayed constant, and since the supply became so low, the prices of avocados skyrocketed. It almost doubled, tripled for around 7 8 months before it again started stabilizing, right? So what happened here? There was a specific demand which was constant. The supply was continuously supplying to this demand, but over a period of time, some external factors created a bottleneck on the supply side. So the product started coming lesser and lesser into the market, which had a demand for that. Now, what happens if you see there are very few houses left in the market, but there are a lot of buyers? What happens? The prices of the houses go up. Similarly, the prices of the avocados skyrocket. So when you have a specific constant demand or an increasing demand, and the supply side is unable to provide or cater to that demand, the price of an item rises in the market. Correct? Makes sense so far? Think about the reverse side also. Now, say for example, Mexico had a bumper crop of avocados in a specific year, right? They had so much that their export quantities at the prices that they were exporting, even they're exporting to the full extent, they still have some surplus lying there. Now, if they start pushing the same product into the US market more and more into this demand economy, the demand is constant. Now, there is a surplus in the supply. As a result of this surplus supply, the prices of that particular item now goes down because there are not enough demand, there are not enough consumers to consume that supply that is coming in. Okay, yes, there are visuals. I think you cannot see my screen. Hold on. Sorry, I did not share my screen. You should be able to see it now. We will start going through these things slowly. Okay, so that is where supply and demand comes into the picture, and that is how supply and demand maintains the price of a specific item. So the price of a specific item at a given point of time, considering all the extraneous factors that can affect the price, is called the fair price of that item at that given point of time. Correct? That is why the market exists. Any market exists to give you the fair price of a particular item at a given point of time. Similarly, when you are looking at a financial chart of a financial instrument at any given point of time, whether it was here or it was here, market felt that that was the fair value of that instrument at that given point of time. That was the decision that the market took. When you see that, okay, I have got a fair price in the market, but I am still going, the price is still moving. So if you are sitting here and you're thinking that, okay, the price is still moving, the price is still moving, the price is still moving, which means the market feels after coming here that given the current scenario of everything that can affect the price of ES mini futures, the fair price of the market is not here but rather up here. And the market went back there. And this keeps on happening whenever the market goes up around some sort of area where the market feels that it is overpriced right now. It reverts the price, brings it down to a level where they think it is a fair value. Till the point of time, bulls will think, now the bears brought the market down, bulls will think that, okay, this is not the fair value is little bit higher, they will again take it higher. Whoever whoever's conviction is more, they will put more money into the market to move the price of that particular instrument, and the market will move in that specific direction. That is how support and resistance is formed. Okay, this is the basic criteria of defining support and resistance. That, okay, my the price here is too low, buyers will buy. If the price starts moving up from there, that is where buyers were sitting, and you can expect buyers to be there again when the price go there. Correct? So that is the area of support that we are creating. Now, if you look at this chart, this is a 4-hour chart of ES Mini. Now, if we look at this was going in a channel, right? So this market had a structure at this point. Since the market had a structure, if you see, it had a defined top and it had a defined bottom. Okay, so within this structure, bears were always present at the top of the structure and bulls were always present at the top of the structure, till this point of time when the bears could not reach the top but came down to the bottom and finally broke it, and then started creating a channel downside. Okay, so this was the area where they formed a kind of a trading range where bulls and bears were fighting. They were deciding which way the market should move, and we came down and created a new channel, right? And the channel was downwards. And again, this happened here. Now, if you see, why did this start happening here? Okay, this was the last big bearish bar, which was taken out by the bulls, and it never came below the low of this bar, and this whole journey continued upwards. Right, since this whole journey continued upwards without taking out this low at all or without creating a lower low, we can very confidently say that this whole area, there will still be bulls available till it is broken down. Correct? So if we extend it to the right, if we extend this to the right, you will see we did not even come there to test it out, and we got support right even before that. Now, where did we get the support? If you want to find out a reason why we get the support, draw the support area, extend it to the left, and see what happened. This was a balance zone. You see here, this was a balance zone. Whenever price moved out of it, it came back here. Whenever price moved out of it on the downside, it came back here again. Finally, we got two big momentum bars by the bulls which broke out this area, and the bears could not come inside. The bulls prevented the bears from coming inside this area again, and they continued. So this area of balance was where market bounced from. Okay, and if they fail here, if they fail to break out, and if bulls again fail in this area, you can very well expect that the market will come and retest this area of support or the area of balance and break this area of balance and maybe come and touch these areas once again. Okay, are you understanding how the market is moving here, how this support and how these two support areas got created? Are you able to understand what I'm saying? Can you please put in the comment? Okay, okay. Quick recap. Okay, whenever the market is in a sideways movement, it creates an area of balance. Okay, whenever the market is in a sideways movement, it creates an area of balance. Whenever the area of balance is created, most of the time, even if the market breaks out to the top or breaks down to the bottom, it comes back to the area of balance. See, it created an area of balance here, it broke out of it here, it created another area of balance here. See, sideways movement, no gaps between the bars. It moved up from here, it created another area of balance. Okay, it moved up from there, it created another area of balance. Now you see, this is the top of the channel. Here where the bears were, they said no, we are at the top of the channel. You have been here in the balance zone for quite some time, 1 2 3 4 5 6, so almost 24 hours. Now we are taking charge and taking the market down, and they got it down exactly till the bottom of it. And see, these areas also acted as your support here. You see that we came here, we could not hold it. We came down, we went up. Bears again bears again tried to push down the market right into the balance zone. They failed, and we went back up again. But now we could not reach the top, and we get a surprise bar. We get one surprise bar. Bulls buy this surprise bar thinking that this will continue, but they do not get a follow through. Since they do not get a follow through, the bears see that they have the opportunity to get the market down and get a second leg down here back to the balance zone again. And then the bulls took over and took it up. Is it making sense now? How the balance zones are getting created and how they are acting as support and resistances. Okay. A balance zone is an area where price has been moving for quite some time. See, this is a balance zone. The price have been moving sideways. There are no gaps that are getting created within the prices, right? And as a result of which the market is thinking in this part that, okay, the price, as long as it is between these two, it is within a fair price range. The instrument is fairly priced at this point. That is what the market is thinking. Okay, so this is one way of doing your support and resistances, is to look for the balance areas, is to look for, okay, these we call as order blocks. Okay, this terminology order block is from ICT, Michael. So when you see a large move up in a specific time frame, for now it is the 4-hour time frame, you mark the last red candle before the move happened, right? So this is the whole area where there are bulls. Why do I say that? It came to the bottom, this candle gapped up. See, there is a difference between the open of this candle and the close of the previous candle. So this candle actually gapped up. Bears tried to bring the market down, but this guy broke out of it, broke out of this area, this whole zone of resistance, and we zone of support, and we kept on going up. Okay, so this is you have to mark the order blocks at every major swing points. So if I say that this again is a major swing point, I will say, okay, this is my order block here. I have an order block here. Now let us go to the right side. We broke out of the order block. Yes, this is being recorded. We broke out of the order block, and we came back and took support at the order block, and we kept going. We came down again, took support at the order block, and we kept on going. Okay, and now this is our major support at this point. Okay, if the market comes and breaks this down, see where it came. This was our major support at that point, because we took support here once, twice, thrice, 4 times, and the market kept going. The fifth time it failed. The bulls gave up. Looking at these bars that were happening at the top, the bulls gave up, and the market kept coming down here. Okay, again, this is where they found the in the balance zone. They did not have to come down till here. They found their support at the balance zone and kept going again. Okay, now this becomes my major support area. How do we if we know support will help the price go, that you will have to see on price action. You do not know, no one knows. Okay, no one can say looking at this candle that the next candle will be bullish or bearish. No one has that power. Okay, even if you say that okay, JP Morgan is putting so much money into this trade, even the trader who is putting that much money is not confident that it is going to be a bull bar here. Okay, they are going by a higher probability trade. So that is, as we go through these sessions, we will see how these high probability trades occur. We will get to know how these what do you see in the candles, what do you want to see in the price action to decide that okay, it is going to be a high probability trade. There were some signs here. Okay, there were some signs that it is going to go up. If you see, we had a wedge, we broke the wedge down, we went back up immediately, tried to reverse, could not break the wedge again, and then we had this bull bar. This is already telling me that the wedge breakout has failed, and there is a high probability of getting a major trend reversal from this area, right? And see, we went from 4980 to we went to 5120. We went almost 140 points, right? So this was a major trend reversal. Now, if you were saying that okay, we have this leg up, this leg came down, I would buy only if I have a candle closing above this line, right? Above the top of this particular candle. So you have put a buy stop order here, right? Now you entered the trade. Suppose you said you are trading on the 4-hour time frame, and you said that okay, this will be my stop loss, the bottom of this candle. The bottom of this candle that broke this high will be my stop loss. You put a stop loss here, you entered the trade here, correct? Now when you entered the trade here, what will be your target? The target will be the measured move of the first leg. So if you want to be conservative, you start counting from here, the open. If you want to be aggressive, you start counting from here. Okay, so if you see, if I start counting from here and put my 50% line at the close of this bar, at the close of this bar, which was the last bar of the bull move, we got the 1:1, 1:1 risk to reward ratio. We got it here. Okay, now if you want to see that okay, how far else can it go, then you may want to say that okay, maybe this is my next target area, and this will be my 1:2 target by the bulls. And maybe if we manage to break out of it this week, this area is easily achievable. Okay, so all I'm trying to say is, and see, as soon as we crossed over this area, bulls, what did they do? They took profit. We had a perfect wedge here on the top. We had a perfect wedge here on the top. We had a bar that completely reversed. We have so much context here. Here also, we had bears, right? Look at these wicks. They all tried to break out of this area, they could not. Even here, when it broke out of this area, it did not get a follow through, came back here, and but see, I would say this breakout was a failure. The wicks means that they were trying to break out and they were failing. They were trying to break out, bulls were trying to break out, but the wicks are showing you that the breakout attempts has failed. It failed once, twice, thrice, four times, and then the bears took over. Okay, so these are signs on the higher time frame that you are seeing that okay, I am in this. So this zone got created here, right? I am in this order block, and once I am in this order block, this is continuously getting rejected in this order block. So there is a high probability that maybe we will get some kind of measured move down, and the price came back till here, right? So if this is my 100% and I put my 50% here, see, they started selling here and they got their measured move. They started selling as soon as they went out of the channel. They started selling. This candle happened. If we just put it down here, this candle happened. Most of the market started selling here. Got two strong bear bars below the 20 EMA. Went back, retested the 20 EMA. This leg was so strong. Even if you had counted only this leg was so strong. It gave us the measured move here. See, this leg was so strong, we went up, retested the EMA, came back down straight to 1:1. So if the bears sold here with one time risk, they got their one time reward here. And they almost got their two times reward as well. EMA is exponential moving average. Do you understand what a moving average is? Okay. So suppose you have 30 people standing in a line, and I want to know the average of every five people, okay, in height. So I go to the first five people, I calculate their height, I find their average, I note it down. I go to the second guy and then sum up all the heights from the second guy to the sixth guy. So again, I have five guys. I get the sum of their heights and I create an average and I note it down again. Then I go from the third guy to the seventh guy. And this I keep on doing till I reach the end. Now I have multiple 5 point areas. I have multiple points where all these five people are getting together. I am getting an average and I am putting it on a chart. When I am going to join these points on the chart with a line, that will give me the five moving average of height of these 30 people. Does that make sense? Does that make sense? Okay, so it is the same thing. Moving average on any time frame, if I say 20 moving average, it is the value of the summation of the closing divided by 20 of the last 20 bars. I take the closing value of the last 20 bars and I get an average for them, and I keep on plotting this line. Okay, so in price action principles, this line is actually defining a support resistance area, that is for sure. This line defines the midpoint of the fluctuations. I'll show you something. I use it on the daily chart for analysis and stuff, but let me get it out. 1 second. This one. Okay, don't get afraid of it. It's absolutely simple. You guys know what standard deviation is, right? Standard deviation of a certain line of a certain point. This is the 20 EMA, right? These are your standard deviations. This is the first standard deviation, second standard deviation, third standard deviation, fourth standard deviation on the top. And again, you have first standard deviation, second standard deviation, third standard deviation, fourth standard deviation at the bottom. If you look at it while you are analyzing, you see most of the time the market stays between the -2 and the +2 standard deviation. Okay, as soon as it goes up, it crosses up, goes above the second one or tries to touch the second one, it comes back and it again goes back down, gets support near the second standard deviation, it goes up again. Here you see it could not even reach the second standard deviation. So if you have this kind of an idea on a higher time frame, you can very easily say that okay, this is the range in which the price will move today. But you need to know that your particular instrument moves in this pattern. So if I look at the on any higher time frame for ES mini, I have seen most of the time the range of ES mini stays within the upper the second standard deviation on the top and the second standard deviation on the bottom. Once it crosses those, you will actually see breakouts happening, sparks flying everywhere. Okay, people will be making money, people will be losing money, and those will be the days when contracts are blown out and people make a lot of money. Okay, so this is just I keep this during analysis. There are so many lines I'm never going to keep on my chart when I'm trading live on the 5 minutes time frame. It becomes too complicated for me. I keep these for analysis, and during that time I keep a note for myself that this is the one standard deviation on daily, second standard deviation on daily. So that is what I keep on looking, and if it's right on the top here, like here, this 4 hour chart, it happened on Friday. I had the idea about this area that we are starting to bend upwards with this candle itself. So when it started coming down, I was kind of sure that at least we will come to the one standard deviation area or a little bit below. So I had most of my trades here, and 5128, anyways, there were multiple reasons. If you had read my posts on Facebook about the next day's plan, I did mention that the 5128 line was very, very important, and it did come down there, retested, went back above the 1 SD, and then closed around somewhere here. Okay, so that is how I use these standard deviations. These are not any definitive lines, these are just guidelines. Okay, and the guidelines will be created based on the kind of move the instrument that you trade in makes. Okay, so if you guys are trading SPY contracts, if you see SPY has a very similar move. This is the RTA chart, that is why you're getting these. But see, this is the first one, this is the first one, this is the second one, this is the second one. See, most of the time it keeps moving between the first look at any time frame, look at any time frame, even if you go up to daily. Okay, see, first, second, it does not go below the second deviation. It does not go below the second deviation. Okay, if it goes, it is really going to be bad for the market if it falls below the second deviation. What do you use to get the I did not write this code. Okay, I am not someone. I got so many lines. I went to chat GPT, I gave them the logic, it gave me the code. If you want, I can share the code also with me. I have spent around 2 minutes to write this, just to write the logic on chat GPT, and I got this code out. Okay, this is the code. What time would be best to do in that scenario? No, no, see, that will depend on what your price action is saying. I told you these are not definitive lines, these are guidelines. Okay, you are not going to go by, these are not your support resistance lines, these are your guidelines. Okay, you don't buy or sell based on this, you buy and sell based on our logic of H1 H2 support resistance measured moves. That is how you buy and sell. You never use these lines to buy and sell. This is just for your analysis. And if you look at how the market is moving based on these lines, you will know that machines also look at these lines. Otherwise, the moves would not have been so accurate. See, exact bounce from the 20 MA went up to 2. Exact bounce from 20 MA went up to 2. Okay. Now, here I can say bulls are stronger. It could not even break 1, and we went back up. And now this is what where we are trying to reach. If we cannot reach here, we will come back to the 20 EMA again. So that is how I create an idea about how the market is moving. Okay, in what direction the market is taking. So that is how I look at it. Does it make sense? Any questions here? I'll give you a minute. If you have any questions, please shoot. This is price action. Okay, the chart is showing you that at a given point of time, this is the fair price of this particular instrument. Okay, and then some bulls are thinking, no, this is not the fair price, the fair price should be higher. They start taking it higher. Now there are signals on the chart that you see this movement, this plotting of price against time, this plotting of price against time, and the movement of price with respect to time is price action. The movement that you are seeing on the chart is price action. Whatever you are seeing on the 5 minute chart, whatever you are seeing on the 15-minute chart, whatever you're seeing on the 1 hour, 4 hour daily chart, that is price action. Our job is to break that down and create some rules in order to trade with it. That is what we learn under price action principles. Make sense? Okay. Now I will show you some more ways to draw support and resistances. Let's go to the let's remove this. I don't need this. Let's go to the 4 hour chart. Okay. So in the 4 hour chart, you see this is the last red bar, correct? I draw a line here. See, we came down exactly inside and bounced from there. We did not go to the low. That means bulls are active in this area. This time we got a higher low and then went and created a higher high, right? Now this area is very big, 498 to 493, 5 points for SPY is huge. This is almost 50 points on ES Mini or more, right? So this is huge. Now what I do is I come back to 1 hour. I come back to 1 hour and now see this area is my actual support. Okay, this is my area of confluence between the 4 hour and the 1 hour. I had a good order block in the 4 hour. I had a better order block inside the 1 hour time frame. Now if I say that, okay, I need to make it smaller. This still is 495 to 493, more than 2 points. It's still not good for me. Okay, you go down to 15 minutes. I don't normally do that, but many people do that. Here you will see this is your support. So now you see you got your support area down to this much. So now you know that if the candle comes here, if the price comes here, I will buy here. I will buy here. I'll keep my stop loss a little below this, but since my stop loss is so less, so little, I won't care to think that what will happen if the market goes reversed. Just 1 point. That's fine. In ES Mini, that will be $50. This support is the area where the market has made a major reversal in the past, and you are expecting that once the price goes down there, it will make a similar reversal once again. And you as a trader will expect that bulls will be present there again, as long as that area has not been broken down and we have got a body closure below this, not a wick. We will only say that this order block on the 15 minutes or this support area on, I am calling, how can you tell that is support? That is what I'm explaining. We came down here, we bounced down here, we came here, and then we bounced so much and we created a higher high. That is why I will consider that there will still be bulls here who will be willing to push the market up. See, this was the order. The biggest box that you see was the order block on the 4 hour chart. We are not even coming down to the 15-minute chart, and we are bouncing from here. So which means this whole area is being dominated by bulls. Now we went above this. We had a small breakout here. Okay, we had a small breakout above this candle. Now see, I did not have to do anything. Look what happened. Are you seeing what happened? This was the breakout support. It just came back, retested the breakout area and continued to go up. Exact same chart as you see on the one that you saw on ES Mini. What time frame is this? This is 15 minutes, right? Let's go to 15 minutes here. Look at this. Same chart. Same area of support and resistance. Do you understand why I'm calling this support now? The bulls became active here again, bounce back up. If it comes back here one more time, I would expect one more life out of it for the bulls. Okay, everyone else making sense? Okay, okay. So now let us go back to that 1 hour time, the 4 hour time frame. So okay, let's remove the drawings from here. Yes, correct. The bulls create support and bears create resistance. You are correct. Bulls are buyers and bears are sellers. Okay. Now on the 4 hour chart, what I'll quickly do. This is my resistance. I will mark it as resistance. Where is that? Where is that? Where is that? Here. Yeah. Sell zone. I'll mark it as sell zone. This is one resistance. This is another resistance. Okay. Now I won't mark it from here. It could not go up from here. So I will say this is another resistance on the 4 hour time frame. This will be another resistance. Here I won't draw a zone. I would draw this line because why am I drawing this line? Because we have a micro double top here. See, two adjacent candles are having the same top, are sharing the same top. So I will just draw a line here. This is my another resistance. Okay, and then this was my previous resistance, broke out, came down, took support here, went up again. Now, this may, if I can manage to go up here, this will turn into my area of support. Okay, and look here, we went up one leg. For these two candles, the bears tried to push the market down. They failed. The bulls posted a strong candle and the market went up again to the next area of resistance, right? So at this point, this will be my support area. See, we bounced from here, we broke above the first candle. This candle came, tested this support area and went back up again. Okay, at the bottom here we will say this is our support area. Again, this will be another support area. These are all 4 minute 4 hour time frame, right? And this is my major support area. Now I will break it down to the 1 hour time. So since the bears failed and it went up, it's support. Yes, exactly. Okay, and when it comes back here for another time, we would expect it to bounce again. Now if you, this is a 4 hour chart, if I, a lot of things happened in this candle. This candle just did not go up straight, right? How do I see that? I come down to the next time frame. In the next time frame, I see here is another support that got created on the way up. If this breaks down 5148, 5133, these 10 points will be my first target down, and then I will hold a runner to this area. Okay, I will come out most of my trades in this area. If I still hold a runner, I will have the stop loss at this level, because, or rather not that level, I will put my stop loss back at this level above this, because this was the latest high that this guy broke out of, right? This was the latest high that this guy broke out of. Since it came down here, if a candle has closed here, it is already telling me this breakout has failed and there is a big chance that we will move sideways like this, and that may happen tomorrow. And if the bears become strong, which I don't think will happen, if we do this once again tomorrow like this, let me draw it out. If we come down here and then keep on doing like this for some time, do you see a structure getting created here? Any one of you see a structure getting created here? No? You don't see a head and shoulder structure getting created? Shoulder, head, shoulder. This will be your neckline. This will be your neckline. As soon as a candle closes below here, you will try to see whether you can get a measured move target down to 5032. That is the measured move of your head and shoulders. But in the process of coming down, they may face another support here, right? They may face another, if you see, this is not a zone, this is a line. They may face another support here. Okay, so your final destination will be here, but you have to take profit at these levels, right? Your final destination is here. This is where you are thinking that the bears will take you down if this head and shoulder structure holds. But if it manages to come down here, you have to take some profit, keep a runner, let it go and hit this area. You have to take some profit here, you have to take some profit here, you may have to take some profit here, and then hold the runner with a stop loss. Oh, then you have to decide and take a call that, okay, I am coming out of this trade, but then I am not going to enter this trade again. If you think you have made enough money with that contract and you want to come out of the trade, come out, but then be very careful when you want to enter the trend once again in the same direction, because your stop loss will be really, really high at that point. Okay, so since your stop loss will be so high, you have to make sure that you manage your trade properly. Getting my point? Okay, what else? So you understood how I look at the major support resistance areas on monthly, weekly, and then daily, and then come down to 4 hour, 1 hour, and finally to 15-minute and 5-minute intraday time frames, right? So once you understand that, I would request you to go back and do the same exercise on your charts and see. Suppose you go 3 days back, you were in a range here, something has happened, you go 3 days back, you mark these areas and then come back and see how the markets reacted to this area. Once you start seeing this for 3 days, 4 days, 5 days, 6 days, 30 days in a row, if you have done this exercise, trust me, you will become a master of marking support and resistance lines areas. You will be able to define which one should form a line. You will be able to define which one will form a zone. Okay, but in order to get to that level, you need to do this practice every day. Take out any chart. If you are doing forex, take out 10 forex charts and try to plot those support and resistances, then come to the right side of the chart and see that how price reacted to those support and resistance. Did it actually react? If you see that, okay, at that level there was no reaction, price just suddenly went up or suddenly came down, then you go back to your left and see if you did something wrong, why the price did not stop at a major point of support or resistance. You go and check that out again. Once you have checked that out and you have rectified that mistake, trust me, you will never do that again. Okay. So head and shoulder is a pattern showing that it will go down. So once head and shoulder forms, okay, head and shoulder formed is not a short enough, is a signal to go short. My candle has to close below the neckline. I have to have candles closed below the neckline, and then I will short one tick below that. I am not going to do a market order. I am going to short one tick below that. If you are doing put options, my premium may be $2 higher, but that is giving me a higher probability that the trade will go in my direction and not pull back and keep going up. So if you look at this chart, we have 5161, 5160. These are points, right? So when we move from 5160 to 5161, we say that we have moved up 1 point. In the process of moving up 1 point, the market uh, describes it as ticks. So every 25 cent is a tick. So 5060 to 5060.25, 5060.25 to 5060.5, 60.5 to 60.75, 60.75 to 61. These are the four ticks that are included inside a point in ES Mini, right? Like in stocks, you have cents. Here we have ticks. In futures we have ticks. We move in increments of 25 cents. So if this is my, if 5099 is the low of my, or is the neckline, I will short at 5098.25 or zero point 0.5. One tick or two ticks below the low of the bar that has broken this line. So if the bar has come and stopped at 5094.75, maybe I will put my stop order to short at 5094, three ticks below. That when the market comes down there, it will take my order and keep going down. Yusuf, making sense? Okay, okay. So this is I would request you to take this as an exercise. Go back, do this practice on as many charts as you want, on as many days as you want. Do it on different time frames. Find out your points of confluences. Go back to older charts, go back to older charts, mark them, see how the prices reacted to those levels, rectify your mistakes. If you have any questions when you are doing this exercise, please reach out to me. You can DM me, you can put a comment in this chat, whatever you please, but make sure you whenever you have a question, you reach out to me. And if you really want to learn this whole process, please start doing these things. This is, take it as an assignment or anything. Yes, I will show you, Kari. Don't be in a hurry though. Okay. I'll show it to you again. So start marking these support and resistances, and you will see yourself improve as a trader in 2 to 3 weeks time. But you have to give yourself the time to do this exercise. Okay, it's not something that you have to promise to me. It's not something that you have to tell me that, okay, suppose we are going to do it tomorrow, or we are going to get it done by next week. Promise it to yourself that you're going to do it, because you, this trading is like a tennis playing career. You play for yourself. You don't give a damn to the rest of the world. You just play for yourself. Same thing here. You're doing this absolutely for yourself. Okay. So I would end it here today, and we will talk again next week. I will share this recording. I do not know if I'll be able to upload it because the file is too big. Uh, but I'll make sure it gets to you, or otherwise I'll upload it somewhere on YouTube and share the link here. Okay, make sense? Okay, thank you guys. See you again next weekend. Have a good one.